Hi, Assalamualaikum. My name is Nurul from SAIPUDZAMAN. My matrix number is 2020589287. I'm from BA194A. Right now, I will present about question 1 for group assignment FIN320. In reference to above information, you are required to calculate the wage marginal cost of capital WMCC and construct investment opportunity schedule IOS draft, and then decide which project should be chosen by the company and state your reason. So first, we have to calculate the capital structure of this project. First, we have to calculate the common stock. So 600,000 divided by 0.3, and it will be 2 million. And for the preferred stock, RM 300,000 divided by 0.2, and it will be 1.5 million. And lastly, debt RM 500,000 divided by 0.5, and it will be 1 million. Then we have to calculate the KCS range up to 2 million. So KCS equal to D1 divided by PO minus F and plus G. So D1 is the dividend at the end of period 1. KCS is the required return on the common stock, and G is the constant annual dividend growth rates. So it will be RM1 multiplied by 1 plus 0.8 divided by 10 minus 5% multiplied by RM10 and plus 0.08. Then it will get 19.37%. So KCS range above RM2 million. So KCS equal to RM1 multiplied by 1 plus 0.08 and divide by 10 minus 10% multiplied by RM10 plus 0.08, and we will get 20%. So since the range of the cost for debt and preferred stock had been mentioned in the question, so we don't have to calculate it, just list it like this. KD equal to range RM1 to RM1 million equal to 10%, range above 1 million equal to 15%, and KPS RM1 to RM1.5 million equal to 4%, range above 1.5 million equal to 7%. Next is to calculate the WACC. So calculation of WACC according to range. So we have to do this table. Range, capital structure, wage, after tax cost, average cost, WMCC. So we have to do it one by one, starting from RM1 to 1 million. So the common stock, preferred stock, and bond. So the weight of the common stock is 0.3, and after tax cost is 19.37. So we have to divide it, and we will get 5.811. And then for the preferred stock, the weight is 0.2, and after tax cost is 4, and we will divide it, and we will got 0.8. And for the bond, the weight is 0.5, and the after tax cost is 10. So we have to divide it, and we will get 5. So we have to plus all the average cost of WMCC. So 5.811 plus 0.8 plus 5 equal to 11.611. So next we have to do for 1 million to 1.5 million. We have to do the same. We have to list it like before. So the difference is for the bond. The difference is at the bond. After tax cost will be 15%. So 0.5 divided by 15%, you will get 7.5. So we plus all the average cost and we will get 14.11. And also for the 1.5 million to 2 million, we have to do just like before. We have to calculate it. So the difference is at the previous stock after tax cost, it will be 7, and we have to plus all the average cost and it will be 14.711. And after that, for the above 2 million, so we have to calculate, and the difference is after tax cost for the common stock. So it will be 20, and 20 divided by 0.3, it will be 6. So we plus all the average cost. 6 plus 1.4 plus 7.5, it will be 14.9. So next, what we have to do is we have to copy the table of investment that given in the question, and we have to add the cumulative investment and we have to calculate it. So what I get is the cumulative investment for Jaya is 1 million, for Extra is 2.2 million, and for the Triangle is 2.8 million. So last, we have to construct a graph, the iOS graph. So the y-axis is the rate of the return in percent. So starting from 5, 10, 15, 20 and 25. And then the x-axis will be the cumulative investment. So it's starting from 1 million, 1.5 million, 2 million and 2.5 million. So first we have to list the rate of the return of these three projects. So first we listed Jaya 80%, so it will be on the top, and then Extra 60%, and last Triangle 11%. And other than that, we have to list the WACC that we have calculated in our answer. So the first will be WACC 11.61%, and then WACC 14.11, and the third one WACC 14.71%, and last WACC 14.9%. So for question B, which project should be chosen by the company, and state your reason. So the project that should be chosen is the project Triangle. It is because the initial investment is below than 1 million, and the cumulative investment is more than 2.5 million.
Hi, my name is ZULKHAIRIZ HAZIZI. My metric number is 2020999977, and I am from BA 1194A. And now I will present about question 2. Question 2A. In capital budgeting decision, the acceptance of certain projects will depend on whether the projects are independent or mutually exclusive. Briefly explain these terms. 5 marks. So the answer for this question is the IRR must be greater than the needed return in order for an independent project to be accepted. Choose the project with the higher IRR if they are mutually exclusive. For example, the project expected an 11% return. We would take the project since the IRR exceeds the needed return. This indicates we are earning more than we need to pay for the risk we are taking by taking on the project. Question 2b. Differentiate between primary and secondary market. The answer for this question is differentiate between primary and secondary market are primary market deals with newly issued securities that involve the issuer and the investors. Other than that, primary market serve as a venue to raise funds. For secondary market, it deals with securities previously issued and it provides means of liquidity to investor to dispose shares. Question 2c. Malaysia Sdn Bhd purchased a machine for RM65,000 excluding transportation cost of RM200 3 years ago. The company would like to replace it with the latest model. The existing machine could now be sold for RM20,000. The existing machine would be depreciated under the straight line method for 5 years with RM5,000 salvage value. The company's earning before tax for the year amounted to RM80,000. The marginal tax rate of 25% and the capital gain tax rate of 30% would be applicable. Compute the total tax liability of the company for that year. The answer for this question is we collect the information from the question. The first one is PP is RM65,000 for 3 years. Transportation is RM200. Sale is RM20,000. The salvage value is RM5,000. Marginal rate is 25%. Capital gain rate is 30%. N is 5 years. And EBIT is RM80,000. For the first step is annual depreciation equal to 65,000 ringgit plus 200 ringgit minus 5,000 ringgit divide by 5, and the answer is RM 12,000 ringgit and 40. The next step is 12,000 ringgit and 40 multiply by 3, and the answer is 36,000 ringgit and 120. And the next step is for BV 65,000 ringgit plus 200 ringgit minus 36,000 ringgit and 120, and it get 29,000 ringgit and 80. For tax shield, 20,000 ringgit minus with 29,000 ringgit and 80 multiply with 0.25, and it will get negative 2,270 ringgit, and EBIT 80,000 multiply with 0.25, and it will get RM 20,000 ringgit. So for the total tax liability, negative 2,270 plus 20,000 ringgit, and it will get RM 70,730 ringgit.
Hi, Assalamualaikum. My name is SHALAHUDDIN bin SHAWAL. I'm gonna explain for question number 3. There are two questions, which is question A and B. So on the question A, we need to determine the expected return and the variance and the standard deviation for both projects. So for the calculation, first we need to find the expected return for both company. The formula for expected return or EV is total probability times with rate of return, which is the probability is 0.40 times with rate of return 10%, and we'll get 4%. For the easy way, just do in a table. Second probability is 0.25 times 11%, and we'll get 2.75%. Next is 0.35 times 13%, and we'll get 4.55%. And lastly, sum the last answer and we'll get 11.3% expected return for TRAS. Next is do the same thing for semi-detached project and we'll get 14.10% expected return for semi-detached. Second is the variance or V. The formula for variance is the total of probability times with rate of return minus total of the expected return squared. So, to calculate, just fill in the formula and you will get the answer for both projects. But, to easier for C, just do a table and fill it. The variance for project terrace is 1.711% and for variance project semi-detached is 4.96%. Now we can calculate the standard deviation for both projects. The formula for the standard deviation is square root the total of variance, then we will get the answer and sure it is in percentage. Standard deviation for project terrace is 1.308% and project semi-detached is 2.166%. Next is question B. So, on the question, we need to construct the depreciation schedule using SYDM. The statement say, Ira Cafe bought a machine at a cost of RM65,000 with useful life 4 years. The installation cost is RM10,000 and transportation cost is RM5,000. It has a salvage value of RM2,000 and will depreciation using SYDM. So, firstly, we need to find a sum of the year DG or SYD. The formula is a given that n bracket n plus 1 bracket and divide by 2. N will be represented as useful life. Fill in the formula and you will get SYD and it get 10. Based on the table, it shows the depreciation schedule for the machine. On year 1, using the formula given to find the annual depreciation for year 1. So, the method will be the same from year 1 to the year 4, but the only difference is the rate. The rate will decrease 1 by 1 each year. For example, is year 1. Year 1 rate is 4 divided by 10, and for the year 2 3 divided by 10, and it will decrease 1 by 1 each year pass. So here we can see operating cost will be minus with the annual depreciation and the answer will be put in the book value. As you can see, the annual depreciation amount is the amount that we gain from calculation for the year 1 until year 4. So, after the calculation in the table for the year 4, we should get the book value RM2,000, which is the salvage value.
I come back to me with question 4. Question 4. Easy Berhad is initiating a merger with Didi Berhad. Both companies have agreed that the merger will be based on acquisition of Didi Berhad. The exchange will be based on the market price per share. Balance sheets for both companies are as follows. Current assets 1 million for Easy Berhad, 1 million 200,000 for Didi Berhad. Fixed assets 2,600,000 for Izzi Berhad. 1,500,000 for Didi Berhad. And total of Izzi Berhad is 3,600,000 for Izzi Berhad. For Didi Berhad, 2,700,000. Liabilities and owners equity. Current liabilities 300 for Izzi Berhad, 300 for Didi Berhad. Long-term liabilities 900 for Izzi Berhad, 600 for Didi Berhad. Common stocks 1,000 for Izzi Berhad, 700 for Didi Berhad. Share premium 800 for Izzi Berhad, 300 for Didi Berhad. Retained earnings 600 for Izzi Berhad, 800 for Didi Berhad. For the total of Izzi Berhad is 3,600. For Didi Berhad, 2,700. Additional information. Common stock par value. RM 2 ringgit and 50 cents for Izzi Berhad, RM 1 ringgit for Didi Berhad. Price earning ratio 4 times for Izzi Berhad, 4 times for Didi Berhad. Earnings per share RM 2 ringgit for Izzi Berhad, RM 1 ringgit and 50 cents for Didi Berhad. Question 4A. Market price per share for both companies. So the answer for this question is MPS acquired. The formula is PER multiplied by EPS. So 4 multiplied by 2. So the answer is A. For MPS surviving, the formula is PER multiplied with EPS. So 4 multiplied with 1.4. So the answer is 6. Question 4B. Share exchange ratio. So the answer for this question is the formula MTC divided by MAC, which is 6 divided by 8. So the answer is 0.75 ratio with 1. Question 4C. Post-merger earnings per share for both companies. So the answer for this question is the formula CSTC multiplied with R. 700 multiplied with 0.75. So the answer is RM 525. For EPSN, total merge after merge divide with total number share outstanding. So 1,000 multiplied with 2 plus 700 multiplied with 1.50. So the answer 3,050 divided by 1,525. So the answer is RM 2 ringgit. For post-merge EPS for Didi Berhad, which is target company, 2 multiplied with 0.75 divide by 0.75, and it will get 1.5 divide 0.75, and the answer is RM 2 ringgit. Question 4D. Purchase price of Didi Berhad. So the answer for this question is purchase price MV divided with share X of share acquired with of surviving received from surviving. So 6 multiplied with 525. So the answer is RM 3,150. For PPAC 525 multiplied with 8. So the answer is 4,200. Question 4E. Post-merger balance sheet using the purchase method. So the answer for this question is we will find a new CS issued, which is CSTC multiplied with ER. So 700 multiplied with 0.75, and it will get 525. For purchase price, note issued multiplied with share market price. So 525 multiplied with 8. So the answer is 4,200. For goodwill, PP plus total debt minus total asset, and it will get 2,400. And then we will find a new CS value, which is the formula is par value multiplied with new CS issued. So 2.5 multiplied with 525, and it will get 1,312.50. For CSVAC, old CS value plus new CS value. So 1,000 plus 1,312.5, it will get 2,312.50. For post-merge premium, which is PSC, 800 plus 4,200 minus 1,312.50 cents, it will get 3,687.50 cents. Thank you.
I am Nurul Izzati with RASID, and I will discuss on question 5. From the question, Fifi Berhad has a capital structure comprised of 1,500,000 debt with annual interest rate of 8% and 800,000 common stock par value of 5 ringgit per share. The company has secured a new project that requires an additional capital of 2 million to finance the project. It has consulted an investment banker and has been advised on the following option. Option 1. To issue a 12% bond with par value Rm1,000. Option 2. To issue the new common stock at par value Rm10. The corporate tax rate is 25%. On the first step, I will calculate the current key financial data. Alright, to count the interest on debt, the value of debt times with the cost of debt. So 1,500,000 will times with 0.8. Then the interest on debt is 120,000. So there is non-preferred stock, and the common is equal to common value stock divide the par value. So Rm 800,000 is divided to Rm5, and the common stock is equal to 160,000 shares. On the second step, I will calculate the expected key financial data for each proposal. For the first option, to count the interest on debt, the debt financing will divide to the net proceeds PV and will times with cost of debt. So 2 million will times with 0.12, and it will got 240,000. So there is no preferred stock and common stock. And on the second option, there is no interest on debt and preferred stock. Then for the common stock financing will divide with net proceeds. So 2 million divide with Rm10, and it will got 200,000 shares. On the third step, it will determine the new key financial data for each proposal. For the first option, the interest on debt is 120,000 plus with 240,000, and it will got 360,000. There is no preferred stock. The common stock is 160,000 times with 0 equals to 160,000 shares. On the second option, the interest on debt is Rm120,000. There is non-preferred stock. Then the common stock is 160,000 shares times with 200,000 is equals to 360,000 shares. On the fourth step, after we determine the new key financial data for proposal, it will substitute the key financial in database formula. So, to count the EBIT, it will use the formula given. For example, EBIT minus I or interest, 1 minus tax or T, minus dividend and divide to N or number of shares outstanding. So, after solve the equation, we will get the EBIT, which is Rm551,965 ringgit. The next one is the calculation of EPS at EBIT in different level. So, we have to complete the EBIT equation. At this point of EBIT, both alternative 1 and 2 will give the same point of EPS. To prove this, let's substitute the EBIT in the formula. So as a result, we will get the same EPS, which is Rm19 cent. On the next question, determine the EPS for both options. If I, the EBIT is Rm350,000 and the EBIT is Rm800,000. So on the first one, we just have to substitute the new EBIT into the formula. Then it's got the deferred EPS, which is Rm negative 50 cents and Rm 51 cents. Then the EPS for 800,000 EBIT is equal to Rm 2 ringgit and 6 cents and Rm 1 and 42 cents. Then the next question is by using the information from question B. Plot the points in a graph and indicate the point of indifference. So as what you can see, this is the EBIT EPS chart for alternative 1 and alternative 2. So from the table, it shows that alternative from option B is more higher than alternative from option 1.